Welcome to the Opening Bell Report.
Okay, let's just jump right in because the numbers here are, frankly, wild. We are not talking about your standard 10% pop on good news.
No, not at all. This is the kind of move that makes you check if the chart is broken. It's a total repricing event.
The ticker is MOVE, that's Movano Inc. And just to paint the picture, the stock ripped from around $6 to almost $17 in one session.
That's a 140% explosion. The volume was it was off the charts compared to its average.
A completely vertical line. And you look online and the first thing everyone screams is short squeeze, you know?
Of course. That's always the go-to explanation for this kind of velocity. People start looking for low float, high short interest, the usual mechanics.
But that's not really there, is it? I pulled the data before we started, and I mean, the short float just wasn't high enough to cause this kind of cascade on its own.
Exactly. A squeeze might get you, what, 30, maybe 40% on a good day for a stock like this. To get to 140%, you need something much bigger. You need a complete an identity transplant for the company.
An identity transplant. I like that. Because the market is not pricing the same company it was 2 days ago.
Not even close.
Right. Because if we rewind the clock just a little bit, Movano was a completely different story. I remember them. They were a health tech company. They made the EV ring.
The EV ring, yeah. Puts them right in the consumer wearables space. Think Aura Ring, that kind of thing. Yeah. Tracking sleep, heart rate, all the usual metrics.
And the tech seemed okay, but that sector's just brutal, isn't it?
Oh, it's a graveyard. You're fighting Apple and Samsung. The hardware margins are razor thin, and customer acquisition is incredibly expensive.
So the old Movano was basically a company burning cash in a really, really tough market.
Precisely. And the stock price reflected that. It was priced like a struggling small cap with a neat gadget, but a very uncertain future.
And then the news drops. The catalyst. They announce a merger with a company called Corvex.
But it wasn't even the merger itself that did it. It was two words buried deep in that announcement that triggered everything.
NVIDIA and H200.
And that's all it takes in this market. The market is absolutely desperate for one thing right now: compute power. By securing a lease for NVIDIA's H200 GPUs, Movano basically screamed to the world, "We are out of the ring business. We're an AI infrastructure company now."
They're selling shovels in a gold rush.
They've secured the most in-demand shovels on the planet.
Okay, let's drill into that hardware for a second, because I think a lot of people just see NVIDIA and hit the buy button. Why the H200 specifically? We all know the H100 has been the big workhorse.
Right, so the big bottleneck in AI right now isn't just the processing speed, it's memory bandwidth. The H200 is the first GPU to use this new HBM3E memory. It has way more capacity and much higher bandwidth than the H100.
Which is key for inference, right? Not training the models, but actually running them.
Spot on. The H100 was the king for building the big models, for the training phase. But now that those models are built, your GPT-4s, your Llama's companies need to run them at scale. And these huge models are memory hogs. The H200 is built specifically for that inference job.
So Movano isn't just saying we have chips. They're saying we have the exact chips that are most needed for the next wave of AI and are also the hardest to get.
Correct. And that supply constraint is real. It's not the silicon. It's the advanced packaging, the CoWoS process at TSMC. It's completely maxed out. So if a small outfit like Corvex and now Movano actually has a secured allocation.
Holding a golden ticket.
Basically, yeah.
Right.
In a market this tight, just having access is the value. It doesn't matter what you used to do. If you have the compute, you have a business model.
But that brings us to the financial reality of it all. Let's look under the hood. Before this news, I mean, the company was burning money.
Oh yeah, the financials were pretty ugly. Negative cash flow, the classic story of pre-revenue tech company trying to scale up.
And now, the analysis report puts the valuation at roughly 14 times sales.
Which is incredibly rich.
Yeah.
And you have to be clear, that's not based on their current sales. The EV ring revenue is a rounding error at this point.
So investors are paying 14 times the projected revenue from GPUs that aren't even plugged in yet.
Exactly. They are buying the rights to those future GPU leases. It's a pure narrative re-rating. The story changed, so the price changed, even though the cash flow hasn't yet.
It's very similar to what we saw with SoundHound, SOUN, earlier in the year, isn't it?
It's the same playbook. The market is so hungry for these pure play AI stories that it will pay a massive premium just to get exposure. They're not looking at today's balance sheet. They're modeling out what the cash flow could be in 6 months.
Assuming perfect execution.
Which leaves absolutely no room for error.
Okay, so let's frame this up for people. Let's do a bull case versus a bear case. What's the blue sky scenario if everything goes right?
The bull case is simple. The merger closes on time, let's say in Q2. The H200s get deployed immediately. Movano instantly becomes a high-margin, revenue-generating machine.
And what's the price potential in that scenario?
The analysis suggests this could push towards $25, maybe even $30 a share.
So still some potential upside from here if they can actually pull it off.
Potentially, yes. Because if they become a reliable provider of this specific type of compute, they either become a cash cow or an acquisition target for a bigger player.
Got it. Now, the bear case. What are the big risks?
Well, the most obvious one is merger delays or the deal falling through. But even if it goes through, there's the dilution.
Ah, right. They need money to actually pay for these chips.
And they're going to get it by issuing more stock. They'll use this high stock price to raise capital, which means existing shareholders will own a smaller piece of the pie.
So for the person who bought at the top, their stake is about to get smaller.
Almost certainly. But the bull argument is, would you rather own 100% of a struggling ring company or 50% of a profitable AI infrastructure provider? That's the trade-off.
And we already saw a little warning sign, didn't we? The after-hours trading.
You did. The stock dropped almost 6% after the bell closed.
Profit-taking.
Classic profit-taking. The people who got in early, the algos that scan the press release first, they're not waiting around. They're selling into the retail hype. It suggests the initial momentum might be fading.
So for a trader watching this right now, feeling that FOMO, what's the key level to watch? The analysis report was very specific.
$14.50. That is the line in the sand.
And why that number specifically?
It was the consolidation area during the breakout. If the stock pulls back, it absolutely needs to find buyers at $14.50. If it holds there, it confirms the market accepts this new valuation.
It builds a new floor for the stock to trade on.
Exactly. But if it slices right through $14.50 on heavy volume, that's a huge red flag. It suggests the breakout was a trap, and you could see it fall all the way back to the single digits.
So, to be clear, do not chase this thing at $17.
Absolutely not. Rule 1 is you never chase a vertical move. You wait for the dust to settle. You watch that $14.50 level and see if the new story has legs.
You know, this whole situation feels like a perfect little microcosm of the entire market right now, this massive split.
How so?
Well, you have these traditional solid businesses trading at, 10 times earnings. And then you have anything that even whispers the letters A and I trading at these wild, futuristic multiples.
It's a structural shift. The market has decided that compute is the new oil. And Movano just told everyone they've struck a gusher. They've gone from being a jewelry store to an oil baron overnight.
Which brings up a really interesting question. Are we investing in businesses anymore? The people, the operations, the culture? Or are we just treating access to hardware?
That's the billion-dollar question, isn't it? If a company can double its value just by promising access to GPUs, is the pivot itself the new business model?
Are they a tech innovator or are they just a landlord for silicon? And if it's the latter, does that really deserve a tech company valuation in the long run?
The market thinks so, for now. But you're right, those kinds of businesses, these rent-seeking models, they eventually face margin compression as supply catches up.
Right. When the H200s aren't so rare anymore, what's Movano's unique advantage?
They don't have one, other than that initial contract. It's a trade on scarcity.
So let's wrap this up. The key takeaway here. Movano, ticker MOVE, is a high-risk, high-reward trade. A complete reinvention from a consumer gadget company into a pure play on AI infrastructure.
The explosion in the stock price is based entirely on the promise of those NVIDIA H200 leases. It's priced for perfection, and there are huge risks, from dilution to execution.
And for anyone watching, that critical level is $14.50. A break below that, and this story could unravel very, very quickly.
Definitely one for the watch list. It's going to be fascinating to see if they can actually pull this off.
For sure. We'll be keeping a close eye on it. Listeners, stay cautious, do your own research, and don't chase the hype.
We'll catch you on the
Don't forget to like, share, and subscribe for more.